The Financial Accounting Standards Board Statement Number 15 has to deal with accounting for troubled debt restructurings. Statement number 15 is an older statement as it was issued in June of 1977. This statement is still around today, although it has been changed and amended throughout different Fasbs throughout the years. The Federal Deposit Insurance Corporation defines a troubled debt restructuring as a debt restructuring in which a creditor, for economic or legal reasons related to a debtor's financial difficulties, grants a concession to the debtor that it would not otherwise consider. This statement establishes standards of financial accounting and reporting by the debtor and by the creditor for a troubled debt restructuring. This statement requires adjustments in payment terms from a troubled debt restructuring generally to be considered adjustments of the yield or effective interest rate of the loan. So long as the aggregate payments, both principal and interest, to be received by the creditor are not less than the creditor's carrying amount of the loan, the creditor shall recognize no loss, only a lower yield over the term of the restructured debt. Similarly, the debtor recognizes no gain unless the aggregate future payments, including amounts of contingently payable, are less than the debtor's recorded liability. A debtor that transfers its receivables from third parties, real estate, or other assets to a creditor to settle fully a payable should recognize a gain on restructuring of payables. The gain should be measured by the excess of 1. The carrying amount of the payable settled over, and 2. The fair value of the assets transferred to the creditor. A debtor that issues or otherwise grants an equity interest to a creditor to settle fully a payable shall account for the equity interest at its fair value. A debtor in a troubled debt restructuring involving only modification of terms of a payable, that is, not involving a transfer of assets or a grant of an equity interest, shall account for the effects of the restructuring prospectively from a time of restructuring and shall not change the carrying amount of the payable. A creditor that receives from a debtor in full satisfaction of a receivable, either 1. Receivables from a third party, real estate or other assets, or 2. Shares of stock or other evidence of an equity interest in the debtor, or both, shall account for those assets at their fair value at the time of the restructuring. The excess of 1. The recorded investment in the receivable satisfied over 2. The fair value of the assets received is a loss to be recognized. After a troubled debt restructuring, a creditor shall account for assets received in satisfaction of a receivable the same as if the assets had been acquired for cash. A creditor in a troubled debt restructuring involving only a modification of terms of a receivable, that is, not involving receipt of assets, shall account for the effects of the restructuring prospectively and shall not change the recorded investment in the receivable at the time of the restructuring, unless that amount exceeds the total future cash receipts specified by the new terms.